Everything we do is a function of speed and how much quicker, cheaper, faster can we do it. We've done a time study on every single step of our unit turn process, and we control all the variables now. That's the big thing about the operator side is I don't want to be reliant upon anybody else. So we brought everything in-house.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris. And today's guest is Justin Spillers. He's the co-founder of Real Estate Alpha, a real estate investment firm with 600 plus units across Ohio. He's a licensed real estate and corporate attorney who spent years advising hundreds of businesses and even scaling 2 startups to 8-figure assets and 9-figure returns. Today, Justin leads Real Estate Alpha's preferred equity fund, which offers accredited investors a fixed 12% annual return, effectively a 12 to 19% taxable yield, thanks to a uniquely tax-advantaged structure. I'm looking forward to digging into that. His background in law and finance underpins a strategy focused on risk management and consistent passive income for high net worth individuals. Justin, thank you for being with us today. That is a mouthful of an introduction. We appreciate your time. How are you today, sir?
I'm great. Living the dream over here in Minster, Ohio. We had our first snowfall, so kids are all excited.
Justin, I'd love to make fun of you because we live in Wilmington, North Carolina, and 2 nights ago, we had our first snow. It was 80 degrees, and the next day, it was 45 during the day, 20-something at night, and it snowed for about 30 minutes. So It's not just you, my friend. All right, Justin, for those that don't know, tell us a little bit about yourself, your background. I know you had a law background and then got into real estate. So a lot to unpack here. Bring us up to speed.
Yeah, so from small town Ohio, Minster, Ohio, I like to call farm country. Did all my schooling at Ohio State, undergrad in law school, focused on real estate law, practiced at a big firm downtown Columbus for about 7 years. Learned as much as I could, always knew I wanted to get out in business for myself. Started investing in real estate about 10 years ago, left the practice of law, started a couple of companies, and found my business partner, Brandon. He's from Piqua, Ohio, real close to me. We're the same age, both 39. Bought our first property together. We both did the same story, listened to Rich Dad, Poor Dad, Bigger Pockets, everything, house hack, bird our way up, and went from 1 property to 600 units now.
I love it. Just as honest as it. We've heard that story repeated over and over. It's usually not nearly that fast, and they're usually not nearly as young as you are, or nearly with the level of success that you had. But it all starts with that purple Bible and house hacking and everything else in Burr, and then continues to go on up. And I had the same story. So that's great. Tell me about your journey from practicing law to 600 units. How did that come about?
Yeah, so my father-in-law owns a large company, and he kind of told me the one thing he could not learn hands-on or on the streets was the legal side of his business. And so he always regretted not going to law school. So that kind of sparked my interest that, well, if I want to get into business, maybe I should go to law school first, try to figure some things out. He also really tried to hammer home, get into business for something that is good and in demand in good times and bad. He tried to get me to go into bread or eggs, the thing he always preached. And I had no interest in that. I did have a manufacturing company for a little bit, but real estate, that a reoccurring revenue stream, people always need a place to live, really piqued my interest. I really liked the tax benefits of it too. And yeah, just got really interested and just read everything I could, watched every YouTube video I could, and then just started diving in and buying stuff and figuring things out. So we started with the 7 unit, which is kind of rare for a first buy, and did really well from there and just built our portfolio up, duplex at a time, quad at a time. We tried to do some retail stuff, did some commercial mixed use, did some storage units. So did a triple net lease deal, some raw land deals. So really tested it all, but value add multifamily property was really where we hit it big and found our footing. And that is all we do now.
So the 600 units, how many properties is that spread across?
So we have about 20 properties. 14 or so of them are like what I call legacy properties, smaller single, doubles, quads. But really the bulk of the 600 is 6 big properties. It makes up a little over 500 of the units. So those 6 kind of are the anchors to our whole portfolio. And we actually have 2 more under contract, a 63 unit and a 48 unit. So another 111 units to add to the portfolio in the year. So we're going to be about 720 units this year.
Nice. Is that the Ohio River Valley area?
Yeah, so we invest the I-75 corridor. It's the main highway system. It goes from Cincinnati to Dayton to Toledo on the west side of Ohio. So we're from the Dayton area. So we invest up that I-75 corridor. So our furthest property north is in Toledo, and we go all the way down south to Dayton right now. But we underwrite a lot in Cincinnati and Columbus. We just haven't found one that penciled out quite yet.
Yeah, nice. Good for you. All right. So you're in a little bit of a unique situation in that you guys bootstrapped for a long time, and you bootstrapped a lot of your earlier deals, and then multifamily, as it sounds like, even starting into the larger multifamily. And now you're to a place where to continue to scale, you've done it the opposite way that a lot of people. A lot of people try to raise money when they have no track record and then go out and build track record. And that's obviously very, very difficult. You guys have established a really strong track record and ability to execute that's well documented. Now you're in a situation where you're raising capital, and the strategy by which you guys are planning to do that is a little bit unique. And I think it speaks to your background of looking at things from the tax yield standpoint. I think that was smart to incorporate that in your very first alternative investment product that you guys are bringing to market. So talk to us about that 12% fixed yield or fixed annual return fund and some of the details around that.
Yeah, so really self-funded to date. Brandon and I, over the last 10 years, we had some other companies. Brandon actually owned a construction and roofing company. I had a manufacturing company and a coaching company. We've since sold those. The real estate investment was just a bigger opportunity vehicle for both of us. So we sold those, but those two gave us the cash flow and the ability to reinvest every dollar. So for the last 10 years, we've not taken any money out of the portfolio. We reinvested every dollar, every refinance, every sale. We have exited a little over 200 units as well as refi. So that compounding is how we're able to use mostly our own money this entire time. So we haven't had the need to capital raise, but we're kind of at a crossroads right now. We have the entire team built up, the entire infrastructure. We know we can get to 5,000 units in about 5 or 6 years on our own with our own money. We want to do it in 3 years. And the only way to do that is to supplement our funds with some private money. So we created our pref equity fund. It's a preferred equity fund for full alignment, meaning in the capital stack of our portfolio, the banks always get paid first, but our pref equity investors get paid second. That's super important to us. So it's full alignment. And then me and Brandon are the common equity behind it. So we kept the structure very simple. You have an ownership stake in our entire portfolio of all 600 units and all future purchases as well. So there's no conflicts of interest. And the three big benefits is we pay that fixed 12% rate. We pay it out every year. It's not a pref. It's not accrued. The second one is that there's no long-term lockups. After the first year, just with 90 days notice, you can get your money back if you need it. And then lastly, that tax strategy you said, because this is a pref equity fund, we can consider those distributions return of capital. So you don't actually pay tax on it until year 9. So it's pretty interesting. If you invest, let's say $100,000, those $12,000 payments every December 31st we send you for the first 8 years is all tax deferred. So you get to use the full $12,000 amount, and you don't pay any until you draw down your entire capital account. So basically, you get a flip when you realize the gain, as opposed to like if you're doing hard money lending, for example. And then that effective yield is really closer to that 15 to 19% you mentioned, because you get to use the full 12,000 each time. So we thought it was a pretty good win-win for everybody. We just rolled it out. Haven't had to raise much money yet, but for these 2 new purchases, we're trying to raise a little bit of that down payment. So excited to get it out there and get some feedback on it.
So for somebody who's maybe new to syndication, they understand the concept of equity. They maybe even heard of, preferred returns and things like that. Give us a brief explainer of what the difference between common equity and preferred equity is.
Yeah, good question. So if you look at a business as units, let's say there's 100 units of ownership in that business. So basically the owners get a slice of that 100 units. Typically everybody would be in the same tranche, like you're all common equity owners. You all have a piece of the same pie. Well, what preferred equity does is it actually creates a vertical stack so that, let's say 3 of those units are considered preferred equity and the other 97 are common. Those 3 units get the money first, right? They get to be made whole, whatever they have as their investment account. They get that back before all the other 97 units get anything. So if you view it as a silo, you always have the bank first in the capital stack, and then preferred equity comes next. It's kind of like mezzanine debt, that mezzanine tranche. And then the common equity is behind it. So it really allows the investors to feel good that all of the common equity is really their buffer, that only if you can't cover all of that would they not be made whole, which is pretty rare in real estate right now. You'd have to be pretty underwater for the preferred equity not to be made whole. That's why a lot of investors really like that position, because it sits above all the other rest of the common equity holders, which is me and Brandon.
So let me ask you this. This seems like with those kind of consistent long-term returns, it seems like something that would be great for like retirement dollars, self-directed retirement funds, SDIRA, things like that. But because this is an equity position and you guys are using debt, my assumption is that this potentially could be on the table for UBIT or UDFI, like unintended business income tax or something like that. Or would it not be eligible for that because it's more looked at as a debt fund, or does the equity piece make it that it potentially could?
Yeah, so we have a really good tax attorney, Ed Ratemeyer. He's a managing director at CBiz. We structured it around that on purpose. So Equity Trust is a huge self-directed IRA player. We already have 3 investors invest with us through Equity Trust, through their self-directed IRA. So again, you're getting checked with your own CPA. But per our fund CPA and Equity Trust, you can invest through a SDIRA into our fund, which is pretty unique as well. So that is an opportunity for people looking for long-term investment as well.
Gotcha. Okay. This is awesome. I gotta ask you, how's it been received? Like when you're bringing this to market, right? Everybody right now is advertising. We've seen groups tragically since the interest rate shot up at the end of 2022, especially in the multifamily space, and even more so in office. It's been a little bit of a bloodbath. We've had groups out there that have paused distributions, groups that have had capital calls. That's why I love the idea of bootstrapping and do things the way that you guys have versus some of the people that have really been stacking layers of debt with very high risk in terms of mezzanine debt, second position, variable rate. That's come back to bite a lot of people. So I love the way that you're doing this. One of the things that we're seeing is for people to raise capital, we're starting to see people continuing to push up their IRR metrics to the point that a lot of the investors we talk to just don't believe them. And it's like, yeah, whatever you're proposing or saying you're going to hit is great, but that's pro forma. What are the actuals? And we're seeing people pull back towards those things that are a little bit more, I'm not going to use the word guaranteed, but stable, predictable, and projectable, right, for the future. So how has this product been received in the market, and what made you design this the way that you did?
Yeah, it's been really good so far. If anything, though, that's been the one regret we have is we haven't networked very well. We didn't stay in touch with a lot of our warm network, kept them up with what we were doing because we never thought we'd have to capital raise. And second, we've just been so head down focused in growing our business that's kind of got lost to the side. So now we're trying to make up for that time and reconnect and reach back out to our warm network. So it has been that a little bit of a learning curve. We just started raising not that long ago. So in the short amount of time, it's been really well received. I hope that equates to people actually investing. But the structure, you're right. We never wanted to syndicate. I've helped to build syndications in the past. As a real estate attorney, I had a lot of clients do it. I've invested in them. And the alignment's just not there in my mind. And you're completely betting on the operator. So we wanted to wait, make sure we had the track record before we ever took anybody else's money and built up that rapport and that relationship and that trust. And then also have the equity cushion to substantiate any type of returns, right? And so what we've done over the last 10 years is build that equity cushion. We only have 50% LTV across our entire portfolio. So we have a massive amount of equity protecting our assets. We can tap into our global cash flow of all 600 units. If for some reason one property has a bad a month or a bad turnover rate, for example, we can support it with our other property that cash flows really well. So that was kind of the intent behind it. But no, I'm really excited to get it out there, have more meaningful conversations, get more feedback. But so far, it's been really good.
Yeah, based upon what we've seen recently, we're kind of looking at a debt fund or cash flow fund ourselves in the future. And I think you're on the right track. I'm excited to continue to watch your success. Let me ask you this. My experience with attorneys is that you guys typically have a fairly robust perspective when it comes to risk, right? What's the worst case scenarios and walking that out and trying to make sure that you guys have protection in place. I think there's a natural, this makes sense as you putting together something that's going to be risk averse or hopefully so. And I've heard you make the comment that every investment is engineered for protection first and performance second. Notably, Real Estate Alpha does have a flawless track record with no investor payments that were missed. So talk to us about like the safeguards or strategies that you guys are implementing that really kind of gave you that engineered for protection first and performance second mindset.
Yeah. So on the risk mitigation side, I'm hyper focused on that being an attorney. You hit the nail on the head there. There's a lot of good protections we put in place. First, we don't nickel and dime our investors. We don't charge acquisition fees, refinance fees, all these things that stack up quickly. You keep it super simple. There's no money being charged fees from the fund side. Second, you have full operator commitment and alignment. Brandon and I have reinvested every dollar into the fund. And as we reinvest, we actually dilute ourselves to the benefit of the preferred equity investors because they're ahead of us. So we really sign up on that full alignment from the 12% being paid to them first. Third is underwriting. We are hyper focused on underwriting well on the front end. We've probably spent $500,000 on mentorship mastermind, building out our underwriting model. We are very vigilant and principled to our numbers. We underwrite 100 deals a month. So super high volume. We're looking for needle in a haystack type deals. We have a massive acquisition team in-house. We built a large flywheel to get a lot of good connections made so that we can work on deals for not just months, but years until it's the right time to buy it. So we make sure we buy right. We also have the commitment we give your capital back in 90 days. So there's no long-term lockups. We're also investing in middle to low income housing classes. So we're not investing in high rises in downtown Columbus or Cincinnati. We invest in good workforce housing, C plus class property, and good markets so that even in bad times, there's still a high demand for our properties. So we're really vigilant on the asset class we do invest in. And then the big one is the replacement cost. You can't compete with our value add side. We're about $50,000 a door as our cost basis. We put about $10,000 in per unit. We're all in at $60,000 a unit. To build new is $200,000 to $250,000 a unit. So we're a fifth of the cost of new construction, and we can get 90% of the rent that new construction can get. So they get a 10% premium, but they pay 5 times more. So that risk profile is very attractive to us and our investors. And then lastly, the Black Swan event. This is the only reason I was even willing to take investor money. Last year when we created the fund, my parents were our first investors. I would never jeopardize or risk their retirement if I didn't have a backup plan, which is a couple years ago, we ran our entire operation with 4 guys, 300 units. Right now, we have a team of about 50 because we're scaling. We're doing heavy unit turns in-house. Everything's fully vertically integrated. World War III breaks out, worst case scenario, I could lay off 90% of my staff. Me, Brandon, and 4 guys could run all 600 units, keep the lights on, pay the banks, pay our investors, cash flow, and do really well. And that backstop really lets me sleep at night and take investor money, knowing my worst case scenario is I just go back to leasing and doing collections and hustling like we used to do back in the day.
Do you just want us to follow up? Or?
I do. I feel like I've asked 5 questions in a row.
I noticed.
Do you want me to slip you a smart question to ask, Neil?
No. But if you had a follow-up on that question and not the next question.
I got to be honest. I mean, the vertical integration side of things, I think this is being approached from a very savvy, you got the track record, you got the capital raised in a way that one of the challenges with capital for projects like this is that you end up chasing an IRR, right? And the thing about that is your highest value add is typically going to be in the first few years when you're doing the value add on the property, you're buying workforce housing and you're making it nice. You're putting in the LVP, you're putting in, maybe you're doing granite countertops or stainless or whatever it is, but you're doing something to increase the net operating income. And that goes up and that's where the value increases. And at some point, you've got to have an exit to pay out the investors. If you're solving to an IRR and you have something that doesn't go right, it really can put pressure on the project in a significant way. I love the way that you guys have a lot of downside protection for the investors in terms of the preferred equity, but you also have protection on yourselves. And you're not going to have pressure. If you need to ride it out and hold the project for longer, you can do that. And that IRR is not cannibalizing your GP return on the back end. So I think you guys are structured pretty well. The one thing that I am curious about is 2 things. You said there was no fees in the fund. So I'm curious as you're transitioning to raising money for this, if you're going to implement some kind of marketing fee or if that's just going to be fixed overhead costs that you guys are eating as you're getting it out there and trying to advertise the fund. And then the second question is the liquidity. The option for liquidity is after the first year, you're offering 90 days notice to get full or partial out of the deal. I'm wondering if you have protection on that to make sure there's no run on the bank, that you're going to liquidate up to 10 or 20% of that fund. So those are the 2 things I'm curious about. How are you going to pay to advertise the fund? And what's your fixed, how are you going to cover the fixed costs of capital of raising? And then how do you handle that liquidity option?
Yeah, good question. So the fixed costs right now are coming out of our parent holding company that Brandon and I own. So those are where all the expenses sit now. They don't sit inside the fund or the property holdco. Our parent holding company is doing all that and absorbing all those costs right now. And then as far as the liquidity, we have 4 levers to pull on. First one is me and Brandon keep a sizable amount of liquidity on the sidelines for banks so that we have that so we can close quickly. If we'd ever need to take an investor out, we do it quickly. Over the last 10 years, we've only ever had 2 people need their money back. And those were early on, one to buy a house in Tulum and one wanted to start a business. We got them their money back in 7 days. So very fast, just cashed them out. And then both have since reinvested with us, which is good. So first one is we would just cash them out with our own liquidity. Second is we have a lot of properties that have a lot of equity in it that we could refinance very quickly. So within 90 days, certainly, typically 45 days or less, we have a lot of really good lender relationships. That would be another way to free up capital quickly. Third, we could always sell a property. This is an evergreen fund. We have full control over the entire portfolio, so we could sell one of our bigger, better assets to get liquidity quickly. And then lastly, we'd have a new investor take out that investor. So between those 4 options, that 90-day advance notice gives us a lot of time to plan for all those scenarios. And we haven't raised very much money. We only have about $3 million of investor money, and all of them are my friends and family. So they don't want their money back. They would actually be mad if I gave them their money back right now. So I feel comfortable about them. They all live within a couple miles of me. So that is comforting as well. But as we grow and scale, certainly we'll have to be a little bit more cognizant of the liquidity we keep and just to make sure we have a better handle on that. So that is built into the future plan of the fund.
So help me understand sort of what the investment process looks like. What's your minimum?
50,000 is the minimum, but 100,000 has kind of been the average check size. We're looking for fewer investors for bigger amounts just to keep it a little easier. We're not looking to build an entire sophisticated investment raising machine. We kind of like the way we're going. Brandon and I plan on still bringing most of the capital to every closing. So this is kind of like a small supplemental as needed.
And then what does the timeline look like? I put the $50,000 in, $100,000 in. When does the cash flow start? How does the tax advantage work? You sort of talked about the fact that, once you've sort of gotten the whole return on capital is when the tax advantages age out. Help me understand that.
Yeah, so we take the capital today. There's no soft commitments. We put it to work immediately and start getting that 12% as soon as it's funded. And then every December 31st, if you're in a partial year, you get your pro rata 12% on the days that you'd invest. And then starting the full year after that, you'd get the full annual 12% paid out on December 31st. And then every year we give you that option. Typically, we'll reach out right around October 1st, that 90-day window, say, do you want the 12% or would you rather reinvest it for that pre-tax compounding? Or do you want it paid out? And if so, here's your capital count and you can draw down your original principal all the way down to 0 before your tax, which wouldn't happen until year 9. So we give a lot of flexibility there at the back end. And we also ask if you want all or some of your money back with that liquidity option too. So that way we get kind of a heads up end of year planner. October 1st, we know then which investors want the 12% paid out and or some of their money back. And then the ones that take the payout, they're going to get a K1 that shows that depletion of their capital account. So there's no actual tax hit to them on the 12,000 and the 100,000 situation. And they get to keep deferring it until year 9.
Interesting. So no monthly or quarterly distributions, just one big check at the end of the year of their choosing. They can take the draw, they can let it compound, they can take a partial draw, and then they let you know if they want to roll on or cash out.
Yep, we do have a backup Class B share that's 10% quarterly. If somebody does need more cash flow more frequently, we have not had any investors take that option yet. It's all been the annual 12%.
Yeah, interesting. What a unique structure. I like that. That's cool. I find that the best of ability right now is availability and optionality. If you give people, you have something that's open right now that's not dependent upon finding deal flow, and it can be safe, secure, and sufficiently stable where people want to put their capital in there and leave it for a long time. That's typically the way for you to get the cheapest capital than to pay a higher IRR return to get something on a project by project basis. And really what you're looking for is get investors that want to put the money in there because they know, like, and trust you. They know what you're up to. They understand your ethics, your morality, your transparency, and everything else. And they're good to just park it and you guys continue to roll together over and over. Like you're raising capital one time is the idea. Like you raise that capital, you've got a war chest, and now it's time to go to war. I love that.
Exactly.
All right. So a rather indelicate question here. You're not taking any ACT fees. You're not taking any construction fees. You're in the common equity below the pref equity. Justin, how are you and your partner getting paid?
So historically, we've not taken any money out of the entire portfolio whatsoever. We've had our other businesses, our other income streams. We keep money invested in the markets. That's how we sustained and lived off of everything. We do have the structure now. So free cash flow, we do have a lot of it right now because the DSCR rate's really good. We have the option to take a draw if we want, which is something we're looking at next year if that's coming into play. But again, that only would happen after all the pref equity, the free cash flow is allocated to them, and then anybody who wants their capital backs paid first. Then we would take a minimal draw, something akin to a salary. But that's something in the future we're looking at into.
Yep. It's a long pathway to get there. I mean, I think you guys have done it the right way. If someone tried to start out with that strategy from the beginning, they would probably starve to death. But because you guys bootstrapped and you've got a lot of projects that you've done on your own that are cash flowing and you have cash on the side, that's the way to get it through. Because otherwise you're entering a valley, right? That's what we say is when we started doing our projects, it's a long time to pay out, 5 years before there's a really cash out. The GP makes money in a significant way. And you're kind of entering that valley and you can see the other side, but it's a long ways away. But the result is when you guys get there, first of all, you're fine, you're stable because you built up those assets ahead of time. But when you finally going to get there, you're going to be in a great position. And I think there's no doubt. I mean, your timeline of 5 years, bootstrapped, or 3 years with other people, it's a classic example of the whole being greater than the sum of its parts. And the biggest thing is your investors are just going to want to stay in. So I have no doubt you're going to continue to scale from there.
All right, I've got one last question before I think we'll start to wrap it up. Have you ever sold a property and exited it completely?
Yeah, we sold about 200 units so far. A lot of them back in 2021. Really, we went full cycle on some larger properties, meaning we finished our CapEx plan, saw the increase in rents, got the increase in NOI. We wanted to make sure we could sell them and kind of realize the gains, which we did. And we took all the money and reinvested it into our portfolio. So we have gone full cycle, a little over 200 units. We're in the middle of looking at some agency refinancing on some of our other larger properties that we fully stabilized as well. So we're going to keep all the properties now. We don't intend selling any. We're going to do long-term holds. So those would be some, I guess, quasi exits, and those appraisal numbers would be coming in really good for us.
Yep. Come on, rate cut Q4. One more, right? Well, just go ahead.
No, I was just going to say, I guess the last big missing piece is the value creation. I think you guys might find pretty interesting and why invest in us and what's the secret sauce about what we do. If you give me a minute, I can kind of give you a quick example of that.
I'm all ears. Now I'm wildly curious. Lay it on me.
Yeah, so 10 years, we've done everything, right? We've tried it all. I've already hit on half the value we make when we buy right? We're looking for those needle in a haystack deals. The other half the value is speed. We have done everything under the sun and we've learned we need to control it all. So we've brought all operations in-house. We're our own in-house property management, leasing, maintenance, and construction team. So we do it with our own W-2 employees. That way we control speed, cost, and everything from start to finish is all a function of scoreboard tracking and how fast can we do it and can we do it faster the next time. So a great example of this is when one of our 600 tenants posts that they're moving out and get notice, our leasing manager goes in, posts a 24-hour wellness check, goes in, does a full video walk through the condition of the unit, gets it to our construction manager. Our construction manager reviews it. We only have 3 unit turn types now, classic, plus, silver, gold. It's standardized across the entire portfolio. We use the same 75 SKUs in all 3. We just add on a level of finish that's higher for each one. So we're looking at how much money do we have to put in the property to increase rents by X, and it's all an ROI calculation we do. So we do LVP floor, paint, trim, appliances, bath fixtures for our classic plus. Silver, we just add on cabinets and countertops. And then gold, we do stainless steel appliances, stone countertops, and a better bath fixture. So those are our only 3 things we do. We have 7 3-man crews and we do it extremely fast. Used to take us 45 to 60 days to do unit turns. Now we do it in 7 days or less. Our goal is to do 72-hour unit turns. So while this is happening, our construction manager fully kits up all the SKUs needed for that unit. The morning the tenant moves out, they deliver the pallet. My 3-man crew comes in. They work 12-hour shifts. Our painters come in at night. And we have the unit fully turned in 7 days or less. All the meanwhile, my leasing manager already has the unit marketed online, 2D, 3D renderings. They're doing virtual showings. They've already pre-leased that unit, and the tenant moves in on day 8, so 0 days down. So it used to take us 2.5 years to 3 years to turn a property. We did the last one in 15 months. We're targeting to do these in 12 months or less. So everything we do is a function of speed and how much quicker, cheaper, faster can we do it. We've done a time study on every single step of our unit turn process, and we control all the variables now. That's the big thing about the operator side is I don't want to be reliant upon anybody else. So we brought everything in-house, and that's the real value creation we've been able to do is time is on our side, being able to use the cash quicker and change the entire culture of that property from a C to a B plus property in 12 months or less.
Justin, that was awesome.
Yep.
That was super cool. I mean, listen, it to be honest, it resonates because that it's the same story that we have a lot. I mean, we're fully vertically integrated. We're finding the deals ourselves. We're raising the capital. We're doing the construction at cost plus 12%. We're doing the property management in-house. Everything is for the purpose of landing at the low enough LTV that it gives you more options in terms of the exit. I've never seen anyone having that much of a systemized approach to the individual unit turn. We've talked to a lot of people in this industry and a lot of people on this podcast, and you're the only ones doing that. And it sounds to me like you're doing it very well. So that's very, very unique. And, speed, a lot of times when we're buying an old vacant Kmart and converting it to storage, people think our advantage is that it's half the cost of new development. But the reality is we're turning those buildings in 10 to 12 months. And for ground up construction, the average is 2 years and 10 months right now for the engineering, construction, permitting, and everything else, entitlement. So it resonates with me because people are going to look at the money and be like, oh, wow, you're doing that, cheaply because you're using your own people. That's great. But they're wrong. It's really about that speed and that velocity. And the faster you get to the point of recapitalization so you can scale and move on to the next one, sounds like you guys have that in spades. That is a very efficient way to take that down. I hope you're proud of yourself because I'm proud of you. I haven't heard of anybody else doing it that way. That's awesome.
Yeah, I appreciate that. And the last thing is we try to always do it better. I don't know if you could utilize this and how you do it on the commercial side. But the new unlock we did for these 2 purchases is we have in clauses now that we can turn the units and start construction before we even own it. Meaning the 2 properties we both put under contract last month for closing end of year, we've already fully turned a unit in one of the properties to our standard. And we're already marketing it. We don't close for 60 days. So we already have a 2-month head start, and the seller lets us do it because if we don't close, he gets a brand new turn unit, and we just gave him a business model for him. And then the second thing is we have in there that the seller can only renew month-to-month tenants. So when we take over in 2 months, we're going to have 3 to 4 months of all tenants only being month-to-month that we can non-renew if they can't afford the increase or transfer to a new unit, so we can turn it even quicker. So those are the things we're constantly thinking about of how do we do it even faster than 12 months and really break the cycle.
Yeah, that's sharp. Well done, man. Super exciting. That's great stuff. We got to land the plane here. I'm going to ask the last question that we ask every guest, and then we'll ask you the best way to connect with you as well, because obviously I'm going to want to read more up on this, and I'm sure a lot of our listeners are as well. Is there any one individual book or resource that you find yourself referring more than any other to friends or colleagues that are trying to learn about this business, real estate, or anything else in this genre?
Not real estate per se. I always go back to Rich Dad Poor Dad, but now Alex Hormozi, I don't know if you're familiar with him. He is the absolute genius of all things. We go to all of his workshops in Las Vegas. His management teams help us build down these and deconstruct our constraints, rebuild our team again and again for the last 2 years. All of his books are fantastic. His content's fantastic. I cannot say enough good things about everything that guy does. So Alex Hormozi's first person I always recommend.
All right. You're the first person to bring that up. So thank you. We have a lot of fans in our office of him as well. So not surprised to hear that. All right, Justin Spillers. Well, listen, if any of our listeners want to connect with you and hear more about what you guys are up to at Real Estate Alpha, what would be the best way for them to do that?
Yeah, I'll drop the link below, realestatealpha.io/invest, and then my email, jspillers@vsfdevelopment.com. I'll share all that too. Those are the best ways. We don't have a lot of social media presence. We've kind of been head down operators, but trying to get back out there and get on the marketing grind.
Sounds great. Well, we'll put all that in the show notes, make sure people have an opportunity to find you here. And Justin, thank you so much. We really appreciate your time and congratulations on your success. It's going to be a lot of fun to watch.
Appreciate it, guys. Thanks a lot.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode. Leave a comment down below or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.